Okay, let's take a look at oil. Up on that report that the U.S. and Iran are experiencing tough sledding in their talks to reduce or forestall Iran's nuclear program. Let's get more from Eric Lee, energy and commodities strategist at Citi. Eric, thank you very much indeed. I know it's a fast-moving situation. You've been working on scenarios that could come to pass between the U.S. and Iran. Broadly, what do you think is the most likely thing will happen? Your case one. You think that there could well be Israeli-U.S. attacks, but they don't result in a dramatic response from Iran?
I mean, like you say, this is a really fluid situation. That's the last 24 hours, the last week has seen a lot of swings back and forth in terms of like the assessment of whether there's might be an attack coming soon or not, or whether talks proceed. So certainly it's a very fluid situation. Our base case is that we do think there could well be an escalation before some de-escalation and ultimately moving back to talks. That's kind of what's behind our recent view that over the next few months we could see the $70, the low 70s for Brent touched several times. We already broke that recently, sold off. We're getting close to it again. Eventually, we do think we head back toward the low 60s, but this is a really fluid situation.
What is your? We're looking at the Brent price now, not far short of $70. Will Brent struggle though to get above $70 and stay there?
I mean, certainly it again depends on the exact scenarios we're talking about. But I think it's important to remember that the backdrop for this is still a very well supplied or even oversupplied oil market. Through a lot of last year, we were bearish in oil, looking for Brent to come off from $80 this time last year, almost down to the 60s, and then finding support here. And a big part of that is that the backdrop is that there's actually still quite a lot of oil out there, not least because OPEC Plus raised production a lot from April last year through the end of 2025, and is holding there for the moment at those high levels.
Is the market oversupplied? We talked to Energy Aspects yesterday, and according to their read on the situation, there isn't clear evidence of a glutted global market right now, but we may see signs of that in the next couple of months.
Yeah, we were seeing signs of that through even the fourth quarter of last year.
Okay.
Our projections for 2026 is that unadjusted global oil liquids, the balance, the supply-demand balance, could be something like over 2 million barrels a day oversupplied. But a very important factor is that China is stockpiling a lot, perhaps at the rate of about 1 million barrels a day. So already soaking up about half of that oversupply. That still leaves, about 1 million barrels a day, right? So do we see supply disruptions? Does that show up? In some ways, it's showing up. And what it will need to do, at least at first, is replenish what are still relatively low inventories. But it looks like, all else equal, that could be coming.
What about Ukraine? Any thoughts there? Disappointingly, there seems to be little progress now on ending the violence, the killing there.
Again, a very fluid situation, and the pace of talks and deal making does seem to be facing a lot of headwinds. So in that sense, we're not expecting any breakthroughs in the near term, but we're cognizant of the possibility that there are, while the deal space, while the negotiation positions on all sides still have a significant gap between them, that there are incentives all around to try to get to some sort of deal at some point. We could see a deal perhaps by mid-year. We do think, among other things, that also the White House is keen to reach some sort of agreement, in part to keep oil prices from getting too high, gasoline prices from getting too high, especially ahead of the U.S. midterm elections.
And I've seen at least one report that Ukrainians are so wary that they're now thinking the unthinkable, actually conceding some territory to Putin.
we'll see what the state of the deal making is, and certainly the impact on oil. It may be a little bit bearish for crude oil, but we think it'll actually be much more meaningful for refinery margins. So really more for the gasoline premium over crude oil, the diesel premium over crude oil, and that's because a big part of the impact is actually Ukraine hitting a lot of Russian refineries with drones. That's affecting the refined product market in many ways more than the crude market.
Could we just talk briefly about silver? Eric, what are clients, what are colleagues saying to you about silver? What a wild ride it's been on. Maybe we could put up a 1 month chart. What are your thoughts on silver?
Sure. I can relay our team views as I'm more of an energy analyst than metals,
Yes,
precious metals. But silver is in many ways also driven by capital allocation right now, like gold. So it's behaving like what we might say is gold squared or gold on steroids. So we're neutral, cautiously neutral on gold at the minute. Certainly a lot of the factors that drive the upside are still there, from macro risks to some extent the Fed independence fears might have been somewhat calmed with the Wash news. But geopolitics are still there, so on and so forth. However, we could see gold fade in the second half of the year, given that we think some of these geopolitical and macro risks might actually ease in the second half of the year. So that's the backdrop. Silver is then is much even more leveraged to these factors. The key thing we might look at is the gold to silver ratio. And so if gold is trading in, say, $5,100 to $5,400 per ounce, if we look at, say, the 2011 low in the gold silver ratio, which was about 32 times, that would point to silver trading as high as $160, $170 per ounce. So we do have a potential price target of $150 silver on the back of that. But again, we note some of these downside risks for gold, especially in the second half of 2026.
Thank you very much, Eric. Really appreciate it.
Thanks.
Eric Lee, energy and commodity strategist at Citi.